Ajay Srivastava joining us, MD at Dimensions Corporate Finance Services. Ajay, great having you.
Thank you very much.
Give us first a sense as to how you're viewing markets. This prolonged period of consolidation, for how long does it last in your opinion? Essentially, that I think is the golden question. So let me take that view from you first off.
So let me give you a silver answer to that, because silver is the flavor of the year. So let's start with the silver answer to that one. It's very stock specific. If you look at what's happened to the market, it's very, very stock specific market. Broadly, it's underlying the huge upright and consolidation continues. My worry is, and I express my worry, that the so-called excitement of GST, I think, has now played out. And the numbers that we'll see in January coming from December results are going to be less than, I think, buoyant as market expects. So in terms of consolidation, I think it will go on to the next year, wait for the budget to come in to see what extra new initiatives come in, what's happened to fiscal deficit, what's the plan for the government and capital allocation. But I think this surprise might be a less than happy results coming out in the January quarter. So in our view, brace yourself for more consolidation. There are lots more things available at much cheaper prices. So you can start nibbling on them, some of the sectors. But the answer is, this equity is not going to perform very much for some more time. We are still way too expensive given the growth rates. I know all the GDP ratio and everything put together, but when you go on the ground, it doesn't reflect in what people and the companies are selling. Leave aside auto, everybody is struggling for sales. So therefore, I think we are in a bigger, longer phase of consolidation. We have still to see the impact of 92, 93 rupees playing out now in the company's balance sheets, in the losses on the forex at this point of time that will come through in this December quarter. So I think brace yourself. There's turbulence ahead, because 92 rupees to a dollar is not going to look good on most balance sheets in India, at least the large caps.
Okay, so yes, more volatility expected ahead and more tempered markets expected ahead. Ajay, hi, morning. Before we talk about the Indian market setup and the sectors or the themes that are looking attractive to you, I remember last time we spoke, you were quite constructive on the US market and especially on the AI side of things. Do you continue to hold that view, and do you believe investing in the US market right now could reap some positive results?
Of course it should. At the end of the day, it's a cutting edge. Doesn't matter which country you are in, you will use the products for the US companies. There's no choice. Yes, valuation can go ups and down depending upon how you enter. And we keep saying stagger entry in any stock at this point of time in the market, in the US market, that's fine. But some of the sectors, it's not a question of whether you should invest. What is the choice? If you look at quantum investing, quantum computation, where do you go? There are only 4 or 5 companies in the world, and all in the US. Between China, Korea, and the US, and I think some little bit of Taiwan, you have to be there, because 60% of where the world is going, where value is being created, is sitting in those companies. And that's why I said, it doesn't matter about valuation. Okay, you may have a lower return, higher return. Luckily for Indians, the rupee dollar has given them the extra cushion at this point of time, so you can withstand some of the volatility in NASDAQ. The fact is, there is nowhere else to invest but that geography if you want to invest in the next age of technology, next age for what's coming for us. And we are a consuming nation. We are not a producing nation for tech. Therefore, at this point of time, you invest where it's being produced and while you earn where it is being consumed.
Right. You seem positive with regard to auto, Ajay. How do you play this theme? If that's where the growth is, do you play through two-wheeler, four-wheeler, passenger vehicle, CV, or through the auto anchor names, or through some of the auto lenders, something like a Shriram Finance and the like? How should one play it?
You summarized it quite well. Actually, summarized it very well. The fact remains that, luckily for India again, there are only 2-3 auto companies in two-wheeler where you can reasonably invest and make a very healthy return. And no prizes for guessing. Every investor knows it, that there are only 3 or 4 stocks, out of which 2 are exemplar performers. One is a laggard, one is gone to sleep at the end of the day. So, but the beauty of auto is that our ecosystem of auto, we are the strongest in the world. Yes, Mexico can put tariff and everything else can happen. Many things can happen in the world in geopolitics. Fact is, creating a grounds up ecosystem cannot come overnight. We are way too strong, whether it's auto and auto ancillaries. And that's why our auto companies are much stronger because the whole ecosystem sits in India. We can supply, we can manufacture, we manufacture for the world at the end of the day. Therefore, it's just not about domestic consumption. Two-wheelers are being exported around the world. And I think India will become the most dominant exporting nation in two-wheelers in next couple of years to come. Therefore, auto theme is not about domestic consumption, in my view. Auto theme is about an ecosystem which will dominate the world in the next 5 to 10 years. And penetration of bikes and scooters is way too low, even whether in Europe, America doesn't exist. It's just a recreation kind of stuff. But leave aside that, huge markets and global markets, including Africa, have so low penetration of bikes and two-wheelers that India has got a great chance. So it's a great story. It's a global story where we're globally competitive. We don't have any other industry at the end of the day, barring maybe a little bit of pharma, but not too much, okay, where we are globally competitive. That's one sector. It'll gain by rupee dollar. We will be export dominant, and export will become bigger than even domestic in the few years to come. So the great story, it has volatility, but write it on.
Okay, so that's on the auto space. Ajay, talk to us about your view on some of the new age companies. Eternal already a part of Nifty. Now we've got news that Swiggy is also going to be included in the FNO segment. So yes, they are making moves and they seem to be inching towards closer towards profitability, at least Swiggy. So give us your sense on where are you seeing some of these new age companies or the platform companies, BPC companies on the back of their acquisition. So much happening in that space. Is that looking exciting?
Exciting as much as a gambler feels excited when it walks into the casino. Okay, so it's a great place if you want to bet. There's no, okay, let me, on a little more serious note, there is no choice but to be part of some of these setups, but certainly not at these valuations. These are incredibly, and market can tell you, market can make me if you look stupid down the line to say, listen, you guys said this to become. Are you seriously? They have no path to profitability. Maybe one or two companies. There is no path to profitability. It's a path to cash burn. Now, does it have to be a genius to know that you spend 2 rupees to earn 1 rupees and investors are putting in money in those companies? Good luck to them. I'm saying this, we are compelled to put in part of some of the new age companies, but the answer is, where do they going to make the money from? Ultimately, one day, the day of reckoning will come and we'll see the valuations where they should be, not what they are. So my suggestion is, it should not be more than 5 to 10% of your portfolio. You got to be there because you feel excited. As I said, you don't walk into a casino without getting excitement. You walk into the market, you want your excitement, go buy these shares, keep them, average them if you can. But remember this, what's happened to a couple of stocks? One stock listed, surprised you with a loss and said, oh, you know what? I forgot to tell you we have a loss. Second guy, just decided that he needs to be just lie consistently. So be careful. The pedigree of some of the promoting companies is very poor. They are sharks. Number two, everybody in the company who's there today is going to sell the shares. So remember this, that you are a buyer in a company where all existing investors will sell their shares in the next 3 years. So be careful what's going to happen in the next 3 years. All of the present guys will be gone. You'll be left holding the baby, and you got to bring the baby up for the next 20 years then. They made the money, they're gone. So, it's not about just fundamental loss making. All of these shareholders are sellers at the end of the point in time. And, I don't like such companies where everybody's wanting to sell. And you know what happened to one of the auto companies? Just ridiculous. So careful, very careful, not because of company also, promoters.
Ajay, you spoke about silver. You hinted at silver at the start of this conversation. Where do you sit with regard to gold, silver? Also, I want to couple that with trying to understand when do you see FIIs likely coming back, which could add some bit of positive momentum to Indian markets?
FIs, when you talk to all of them, everybody answers the same question saying, why are you guys buying this valuation? And the paradigm lies not because in FIs, the paradigm lies in the fact that we have very artificially lowered interest rates, which is compelling people to go invest in markets where they're not making good returns. Everybody is diverting the thing. Income tax helps you, long-term capital gain 12.5. If you have interest income, it's 34% at the highest tax rate at the point in time. So you go pump in mutual funds at the end of the day. And that's what is happening. It's not about FIs wanting to come or don't want to come. You can't ignore India at the end of the day. The question is, do you want to come at a valuation of a retail company at 90 PE at this point of time? When you are questioning, and you started by questioning some of the companies and AI in the US are at valuations of 30, 40, 50 Ps. Indians are paying for ordinary parchun ka dukan, if I were to say so, 90 PE. So why would you want to come and invest and face a depreciation rupees? The question lies not really speaking in terms of whether they will come or not. They will come, eventually they will come, but not at these valuation, and they are coming. Mind you, they are coming with a pound of flesh. Look at all the IPOs. They are making the checks into IPOs where they get a clear market edge. In secondary market, I think it's going to be much and more selective at this point of time. India doesn't give a compelling return story, in including dollar rupee depreciation. It just gets worse. So I'm not too sure it's going to happen in first quarter, next quarter, but I think everything depends upon India's growth story, India's valuation, and if Indian mutual funds start to perform and people start to get a return. Otherwise, you will see a dramatic shift of people. It's already happening. You're not seeing it. People moving their portfolios from Indian equity to global equity and to metals. That will be the theme of 2026, is a seminal shift in capital allocation from Indian equities to metals and global equities.
Okay, Ajay, really interesting views. Thank you so much for your time
Thank you so
today.
much. You have a good day and
Appreciate
a
it.
weekend.
You too, Ajay. Thank you so much.